Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
What happens when I'm off doing my own equipment? Nick wasn't here.
You scared me to death.
Well, buddy, we did a pre-test, you know, it's all right.
I know, I knew you were there. Where'd you go?
Well, you know, I was off at a financial conference. Those of you who are wondering what on earth is going on. This is the Investor Coaching Show, of course. I am Paul Winkler. I've been off at a financial conference, and the financial conference was, oh man, so good. You know, some of it's investing related stuff, you know, some of that kind of stuff. Some of it is a little bit of the psychology because, you know, and, you know, I talk a little bit about that, a lot about it, just simply because so much of what we do wrong with investing is psychologically driven. Mistakes we make. And it's kind of, I was sharing something with my family earlier. It was this picture, and it's just an optical illusion. And your brain fools you into seeing something that just, it's not there. And my wife's like, well, okay, what's the point of that? And I said, well, the point is we do this all the time in our workshops and talk about the brain and how it just fools us. And we just get these results around investing or in investment advisors, you know, the same thing happens. You know, when I worked for the big investment companies, we were often driven to do things that, hey, do this, do that. And some of it's conflict of interest, you know, as far as getting paid more to sell one product over another. But a lot of it, I'm telling you, is just psychological in nature. You know, hence the reason I'm putting together coursework regarding that. So we got a little bit into that this week, and it was really good. And I thought I'd share some things with you, you know, in relationship to that, because I think if you start to understand, you get a little insight as to how your mind works, you can help prevent those things from happening. Just as an example, let me just give you an example. There was something in The Economist. And, you know, The Economist I talk about as being a British publication that deals with economics issues. And they are often, you know, commenting, oh, man, they comment a lot on American politics. They just are obsessed with it. But it was one of these magazines that I had to read when I was, you know, doing my work in economics. And we had to do this, you know, reading of The Economist to bring it back to classroom and talk a little bit about what we'd seen and what we had been reading about. And it was really, really good. And, you know, over the years, I've just kept it up. I keep getting the publication because I'm really enamored with the idea of how economics works and how different things that we can do from tax policy, for example. I think a really interesting thing about that as well, because I had actually something else that I had talked to a guy tax policy wise, and I'll share that later in the show. But I was perusing through The Economist this week, and there was a headline that caught my attention. And the headline was from the editor-in-chief, Zanny Minton Bedos, I guess is the way you pronounce her name, but it was talking about the cover story. And it was talking about how America's gambling boom should be celebrated and not feared. And it says this year, Americans are on track to wager nearly $150 billion on sports. Surprising, not even higher than that. As our briefing, that's a lot of money. I'll take that back. As our briefing explains, the revolution has been unleashed by the overturning of bans, the rise of betting apps, and the booming economy. Consider gambling's seedy reputation. It is tempting to view this as unhealthy and dangerous, they say in The Economist. They're taking the other tack. They said, well, it's true that for some, gambling is a ruinous addiction. However, whereas state lotteries are disproportionately played by the poor, this is The Economist speaking, this is not me, disproportionately played by the poor, the new forms of gambling are less regressive. The lesson from the other countries is not to ban gambling, but to regulate its forms or regulate its harms. Freedom of speech and political liberty are not the only important freedoms. The ability to spend your money as you wish matters too. And you can see that to some point. You know, there are a lot of people out there that are just like, you know, get the government out of everything, don't want them near anything. And, you know, I'm just going to kind of back off and go, you know, I'm not going to take a position on that because I get to choose, you know, whether I'm going to do that or not. But there is an interesting study that looked at people that live near casinos, as a matter of fact, and they found that they didn't gamble more just because they lived in proximity of a casino. So there are people that say, hey, you know what, it's a choice. You get to make your choice, and the government should stay out of it. But, a lot of times you look at the advertising and it is playing to emotions, and we just don't really have great control over our emotions. We know from research. We have a tendency to get pulled into things pretty easily, and we have a tendency to go down. And you think about it, if advertising doesn't affect anything, why do people spend, just untold sums of money on advertising the Super Bowl every year if it doesn't affect our behavior? And it does. We just a lot of times are not as in control as we think we are. And you go, well, what's the role of government? We protect ourselves from, seat belts. Do we do the same thing there? And again, I'm not going to take that point of view, but I want to make a point from an investing standpoint regarding this, because there are a lot of my friends that are just absolutely get the government out of everything, and just that's the way they are. And I'm just like, I'm not going to. I got a lot of other things I want to worry about. I don't want to worry about that. As much. That's not going to be the main thing that I focus my life on. My focus is making people more successful investors and getting them more successful financially, not how the role of government plays in every area. Yeah, I know. No guts, no glory. But anyway, growth of sports betting may be linked to financial woes, the studies are showing. And this is just the other side of the coin. And it says, while states have cheered the new tax revenue from sports gambling, some new studies have linked the burgeoning industry to lower consumer credit scores, higher credit card debt, and less household savings. I've talked about this recently. This is something that is an issue. There are people out there doing desperate things to try to get rich quick because they're looking around and going, I'm not doing well enough. I'm not good enough. There's something wrong with me. I've got to be, if I can just get rich, I would be better adjusted. I'd be happier with myself. I think there's a lot to that. Right? The bankruptcies, they have much, much higher bankruptcies, people that are engaged in sports gambling. And you may be one of these people that can handle it just fine, but this is just the research. Americans spent more than $121 billion on sports, according to American Gaming Association. They said, that state regulation is faint-hearted and half-baked. So they're saying, hey, we need to regulate it more. Other people saying, no, get out of the way. Let's not regulate it at all. But, and there's this guy, he was a senior vice president of strategic communications for the American Gaming Association, and he stepped in and he says, he pointed out to longstanding research, there's no correlation between financial hardship and proximity to casinos, like I was talking about earlier. He says, but he's skeptical of the idea that sports gambling harms households financially. He noted that Americans last year had a record 401k holdings, and it's like saying the stock market's at a record high. It's really kind of meaningless if you think about it, because markets go up all the time, and they go down, and they go up, and they go down, but they tend to go up more than they go down. So the market's always hitting record highs. People say, oh, the stock market's at a record high. The Dow was at 1,000, and that was a record high back in the 1960s. And then it was, 2,000, and that was a record high. And then it hit 3,000, that was a record high, and 10,000, and 15,000, and 20,000. So it's always hitting record highs. People's savings are typically going up. They're not going down because they're adding to them. So, that's kind of a silly statement, really, in my humble opinion, to say that, that they're record 401k holdings and record mutual fund ownership. Well, that's what you own in 401ks typically, so that's kind of silly as well. But they had this guy, he's an assistant finance professor, and he looked at, he says, does it displace other forms of entertainment spending? And he says maybe someone would forego a night out, for instance, and instead put a few bucks on Sunday's game. So maybe not a big deal there, but he says that in Gambling Away Stability, the book that he wrote, he said that legalized betting led households to spend more on both entertainment and betting. So they're just spending more on it and putting less in savings and retirement accounts and investment accounts. And they found that sports betting disproportionately hurt lower income households. So that's just the direct opposite of what they were saying in The Economist. It actually does. And that's where I want to just settle for just a second. Talking about, these people running up credit card debt and overdraft, banking accounts and checking accounts. I think the same thing happens with investing, just in my experience. A lot of times when I look at people that are the way they invest, they have a tendency to buy individual stocks, as if buying individual companies or small groups of companies should give them a higher expected return. And what you're doing is you're buying companies that you like, right? I'm going to go out there and go, who do I like? Whose products do I like? Who do I think is going to do well going forward? And there are a lot of companies that we may look at and say, man, I think that they've got a good future with AI. I think that they make good products. I think politically they're in the right place from a politics standpoint based on the regime change that's going to be taking place. I think they're well positioned or whatever. Well, what you're doing is you're saying that I think that the company wants to pay more to use my money than anybody else. And when you look at it that way, you go, that doesn't make sense that they would want to pay any more. And what I find quite often, this is something I shared at the financial conference with all the other advisors there, I says, I find quite often the companies that people think very highly of are typically selling for a much higher multiple compared to their earnings and compared to their assets. So typically they'll say, hey, I like this company. And I'll go, why do you like that company? And they'll say, well, I think it's going to do this, this, and that, and the other thing. And I'll say, well, did you recognize that we can look at whether that is likely built into the price right now? And often they don't know what I'm talking about. So I will walk them through price to earnings ratio, what price they're selling for every dollar of current earnings, or forward earnings, which is a better measure. I'll look at what they're selling for based on the assets that they have, what the multiple is. And quite often what you'll see is these companies are selling for huge multiples because it is expected that they are going to be successful in the future. That's why they're selling for such a high price. That's the way markets work. Now, so what happens is people will go out there and they're going, hey, man, I'm behind. I haven't saved enough money for retirement. I'm getting ready to, I'm going to probably need to hang it up in 10 years. And I haven't saved as much as I should have. I don't feel as good as I used to. I want to go do things that I haven't done before, because I'm not going to live forever. And people will then get into desperation mode and they will start to do things hoping that they can really increase their returns rapidly. And that's usually what happens, is just the opposite. We play to try to get rich and we end up becoming poor because we don't recognize that we're breaking basic rules of investing when we do that. We're not diversifying. We're buying things high. We're buying things after they've done well or after the information that they're going to have some good, possible good future is already built into the price. And and what happens for investors is then they get hit and then they're 5 years from retirement and it's even more desperate. So then they get into some things that they think are going to, they hear people getting rich doing whatever and then they follow. The horse is already out of the barn and they go and do what somebody else did to actually make a bunch of money. And we only hear about those stories about the people that have done well. So hence what we end up doing is we end up thinking that that's the norm, when it's really the exception, and the media likes to focus on exceptions. And the other thing that we find is this, is a lot of times people do that, and I find the younger people quite often are subject to a lot of these risks that I'm talking about right here. I'm talking about gambling, sports gambling, and those types of things, and just gambling with my investment portfolios. They tend to be the people that are out on the Robin Hoods and they're out on the trading platforms that have bells and whistles and graffiti when you buy a stock, and they play to your emotional need for excitement and your dopamine rushes and things like that. Well, what happens is that quite often these people have not been burnt enough times to recognize that what they're doing is dysfunctional. And that's what I find. People ask me all the time, hey, who do you love working with? And I said, I love working with people in their 50s and 60s because they've been there, done that. They got the T-shirt. They screwed up everything, and they can't mess it up now. They've got to make sure that they get it right going forward. So that's a big thing for me, is to focus on that group of people. But that's the reason, is because I know that they've gotten it out of their system. But there's another thing that plays along with this. There was a guy, I was talking about that I'm at this financial conference, and there was a guy that actually helped set up the American Dream experience that we talk about, helped put it together, Steve Zaffron. And he recently passed away. And what a neat guy, what an interesting guy. And had written a book about, I think it's called The 3 Laws of Performance, as I recall, is the name of the book. And he talks a little bit about why we do the things that we do. And so why do we try to get rich quick? Why do we try to, do things that maybe we don't have the expertise to do, but we try to be self-sufficient in that way? And, I use the example about self-sufficiency. It's kind of a bad idea because we can't be great at everything. Now think about Andrew Carnegie, Napoleon Hill interviewing Andrew Carnegie, who was at the time like the richest guy in the world, steel magnate. And Napoleon Hill says to him, he says, so, you're like this steel magnate, you know everything about the making and manufacturing of steel and blah, blah, blah. And Andrew Carnegie's going, no, I know nothing about the making and manufacturing of steel. And he's like, wait a minute, you made your entire fortune doing that. He says, no, this is Andrew Carnegie speaking again. I surround myself with those people that know everything about the making and manufacturing of steel. I surround myself with experts in everything. And he says, well, what's your job? And he says, it's keeping these people working together. That was his job, making sure that he was, quarterbacking the thing and making sure that he had great people around him. Well, a lot of people, what they'll do is they'll take action in life and they're trying to make up for maybe some sense of lack that they have about themselves. And Steve Zaffron is telling a story in this book about when he was a kid. And I'll butcher the story. Go read it for yourself at some point. Like I said, it's called The 3 Laws of Performance. But he has this great thing in there where he's talking about being a young boy. And he's in school. And they broke the classroom up into 3 groups. They were going along and they had, group 1, group 2, group 3. And it was, I think as I recall, he was put into group 3. His friends and his peers, his good buddies, were put into group 1 and 2, I think it was. And he said, I went to the principal's office. I was like, wait. All my friends are in group 1 and 2. I'm going to the principal's office and find out what the mistake was. And he gets there, and the principal, he says, I just remember looking up at him. He was a huge guy. And he looks down at him. He says, yeah, can I help you? And he says, there was a mistake. I was put into the wrong group. All my friends are in group 1 and 2, and I've been put in group 3. And he goes, no, there's no mistake. And he goes, do you remember that test you took a while back? And he's, no. And he says, well, you didn't do so well on it. And now you're in group 3. And he goes, it's just like, there's nothing I could do. And he said, basically, I was shut out. I was not going to be in the group with my friends because the thing that was more important to me was my time in my social areas. I wasn't really focused on tests. I wasn't focused on academic work. I wasn't focused on any of that stuff. He said, I was focused on the fun that I was having with my friends. And all of a sudden, bam, it hit me. Here I am. I'm not going to be hanging out with them. I'm off in group 3. So he says, he goes on in his life and he just does unbelievable things, goes and gets a master's degree at a prestigious university. He goes on to get all kinds of academic accolades. Now, not only that, but even when he was in high school, he moved up into the high 90s, as I recall the story goes. And he was moved back into the group with his friends. But here's what happened. He never saw himself as being a smart kid. He always saw himself as dumb and that he was really an imposter. And, what happens, I think, with people is so often they don't think that greatly of themselves, and they just think, if I could get more money, if I could get higher returns than everybody else, if I could be just really seen as being a really smart investor, somehow it would fill that hole, that I would feel okay with myself. And I think that to me is just, as I think about that is a hard thing for people to get over. A lot of people want to feel that sense of, just being affirmed and that they're okay. And quite often the way they go about it when it comes to investing is really dysfunctional. You've heard me say on the show before, if I just captured returns, with like $100,000, and I had money spread between, I had $100,000 spread between large companies and small companies and value companies and growth companies and U.S. and international and so on and so forth. If I just went and captured market returns going back to that point in time, I don't remember the exact number, but I want to tell you that $100,000 grew to like 50 million or something like that. Markets have this way historically of providing significant returns historically without trying to pick stocks and without trying to time the market. And what we end up doing is somehow thinking that we can do better. And why do we do that? Heaven only knows. But I'm here to say that maybe there's a little bit of that imposter syndrome, maybe feeling that I'm not good enough, and maybe thinking a little bit more highly of myself than I ought to. I remember being around a lot of people in the investing industry, and it was this idea: I can do this, man. I can do this. I can knock this out. And even the most intelligent investors can only know a fraction of what's knowable and predictable, and this comes from academic research. So what they're doing is they're acting as if they know more than the general consensus of all informed investors, and we just can't. And I'm here to say that you do not have to have predictions about the future. You don't have to be able to do that to be a tremendously successful investor.